My name is Tim Richards. I'm the Technical Services Manager of the Managing General Agents Association. And on behalf of the MGAA, I'd like to welcome you to our briefing this afternoon. This is being delivered by ICSR on the subject of the FCA Business Plan 2023 to 2024. Before I introduce our presenter, I'd just like to run through a few housekeeping points. First of all, please ensure your microphone and camera are turned off. I can hear a bit of noise in the background, so if it's you, just if you can turn your microphone off, that would be much appreciated. If you'd like to ask a question, please feel free to use the chat button at the bottom of the screen. Time allowing, these will be asked and answered at the end of the event. If we run out of time, questions will be answered post-event. We will be running a couple of polls during the presentation just to reassure you that these will be anonymous. This presentation is accredited for CPD points if relevant to your ongoing professional development program. This market briefing is being recorded, and a link to the recording will be issued post-event together with the slides and our feedback survey. Please take the time to complete our survey, which will take no longer than 2 minutes. This allows us to deliver the best possible future events to our membership. So today's briefing is on the subject of the FCA Business Plan 2023 to 2024 from ICSR. So let me introduce you to our presenter, Kenneth Underhill, who I'm sure many of you will know already. Kenneth has over 25 years in the London insurance market and is the former General Counsel of Chubb European Group, then ACE. He was responsible for legal, compliance and corporate governance across the EMEA region. Prior to that, Kenneth was a founding partner of the commercial and regulatory team at Reynolds Porter Chamberlain. He is the founding director of ICSR and alongside his own advisory work, manages their talent pool of consultants. So thank you very much, Ken, and over to you.
Thank you, Tim. Can we move on to the next slide, please?
We certainly can.
Okay.
We've done that one and that one.
Yep. Okay, so very briefly, we're going to go through a quick work on, we're going to look at the background, which is probably as important as some of the other parts of this, the FCA's plan for this year. And then there are some slides for comparing with last year, and I'm not actually going to touch on those. They're really there for you guys to understand where we are against last year's, because this is a part of an ongoing program, I guess we could say. As a part of the introduction, I have to run you quickly through the learning objectives in order that you can get your points, your training points. So the objectives here are to summarize the changes in the approach to regulatory compliance being adopted by the FCA and the strategic objectives. Document the 3 specific areas of focus the FCA will be concentrating on in 2023 to 4 and explain how their firms should approach these. Summarize the likely impact for firms of the changes in approach to non-compliance being signaled by the FCA. Summarize the likely impact of this strategic change on existing FCA work, such as that on the new consumer duty and product governance and fair value, and explain the intention of the new secondary international competitiveness and growth objective being introduced and how that will impact MGAs together with any opportunities it presents. Okay, if we could move on to the next slide. Right, so what we're going to do, this is identical to a questionnaire that we used last year. We are going to ask you to vote with what your current understanding on the strategy and business plan is and the extent to which these these plans will result in changes to planning in your firm's compliance team. So if you want to vote, please start. While we're giving you the time to do that little bit of voting, I'm going to tell you what happened last year. Last year, 71% of the people who attended this call said that they expected change. They didn't know what that would look like yet. So hopefully we were able to explain it to them and they came away from last year's presentation with that. What I would say while we're allowing people to vote is that that was pretty much in line with what Nicol Rathie, who is the CEO of the FCA, was explaining in his own opening this year. So the financial service markets, as we feel, and he said, is going through a significant rapid change. There are as significant background to this plan, there are very high levels of volatility in the markets and in the geopolitical environment. And what that's doing is giving rise to significant risks for consumers. Those risks, according to him, and I think everybody else on the call would agree, include interest rates and inflation. They include the potential for increased unemployment. And I think given that there is the highest level of employment in the country for some years, it's very likely that the figures can only go one other way. So there is also likely to be less disposability of income. Now, we all know what that comes from. That's inflation. And there is likely, at least in the short to medium term, to be continued market volatility. So that's the background to where we are with this year's plan. I think we're going to close voting now. Apparently I get to vote, so I'm going to, no, it's all done, and we will come back to that. Well, there's an interesting thing. So 16% of you believe that there won't be any real change. 64% expect change, but you're not sure what it's going to look like. And 11% of you have already discussed what changes you'll be making. Well, that's pretty quick, I've got to say, because the plan only came out on the 4th or 5th of this month. So congratulations for those. And 9% of you who are not sure what's going to happen. I hope that you and the other 64% will have a fair idea by the time we've ended this. Could we move on to the next slide, please? All right, so we are in the second year of a 3-year strategy, and last year's plan and last year's strategy all talked about innovation. They talked about more assertiveness and more adaptiveness. And I'm almost certain that everybody who is in compliance, who is on this call, would agree that there has been all of that in the past year. I don't know whether to say I'm afraid to say it's not going to stop, or just to say it isn't going to stop, because as it is a second of 3-year plan, we know that they intend to carry on. And of course, there are very good reasons for doing that. There is a lot of volatility. There is a lot of issues for consumers at stake here. And as we'll talk about later, there's been a lot of criticism of the FCA leading up to Nichols' appointment. So he really is here to fix the issues with the FCA and to move it in the right direction. So the 3-year strategy paper set out 3 key areas. We're going to cover these in some detail later, so I'm not going to cover them off at the moment. It also set out 4 desired outcomes of fair value. We know there's been a huge amount of work there. Suitability and treatment, product governance all over, confidence in the market, and access to the market. And those 2 are also being dealt with quite a lot in the past year, and we'll talk about that. So if we could move on. So we've talked about strategy and we've talked about the outcomes, and now we have the objectives. And the objectives of the PRA, the FCA, are to secure appropriate degree of protection for consumers. Now, this is the area that is getting probably the most focus at the moment. We're seeing a lot more Dear CEO letters. We're seeing a lot more discussion papers. We're seeing a lot more pre-assessments, that is assessments of firms' activity to meet new regulations. And all of those are examples of that word assertiveness. So they want to be more assertive, and they are definitely being more assertive. On the protect and enhance the integrity of the system, there's a huge amount of work going on now with financial crime, considerably more active in this space than they've ever been. And again, it's all assertive. We also have this need to promote the effective competition in the interest of consumers. We're seeing that across the market in a variety of different ways, none more so than by way of example, the FCA's approach to Brexit and allowing EU companies to branch into the UK, but not permitting them to be involved in UK business. So that's an example of effective competition, but also protecting the interests of consumers. And we will shortly have a new objective, which is a secondary objective. So it's not those three above are primary. And this is being pushed by the government, and it's a part of its approach to ensuring that Brexit does not have a significant impact on the financial services markets in the UK. So if we could move to the next slide, please. Right, so we've talked about or briefly touched on the three focus areas. We've noted that there are 4 outcomes expected and that there are 3 and soon to be 4 objectives. We now have 4 commitments. And I look at this and I feel like we could all get lost in the management patois here. But if you did that and you just thought, well, this is just, management speak, then I think you need to recognize that it isn't. There is some real substance behind all of this. For example, there has already been £11,700,000 in fines this year. And we are, we're mid month 4, so we can expect to see more of that. In terms of the commitments themselves, preparing financial services for the future, there's a significant amount of work on the digital space that the FCA has been doing, and I'm going to touch on that quite a lot because I think it's probably one of the most important things, and it's certainly for small to medium-sized firms, probably the theme that people need to pick up on. Putting consumers' needs first is the shorter-term issue. But again, it's all about what's going on at the moment, and it's all about consumers. So you've got vulnerable customers. There are significant risks now for consumers generally, as there are monetary issues going on. There is inflation. There are going to be more and more people in the market who are vulnerable, and the FCA has been active in that space with Dear CEO letters and the like. Prod. Also, still a great deal of work going on the prod side for consumers. You've also got the value distribution work going on still, and of course, coming up is consumer duty, and we'll cover that to an extent later on. So that's that's your short-term primary concern at the moment. The longer term has to be preparing for the future. Reducing financial crime. Again, significant work going on, and then strengthening the UK's position in the market. Well, that's about post-Brexit. That's about the Edinburgh reforms, and again, we'll touch on those. New slide, please. Okay, so we're going to look at these in some detail. We're back to the foci, is it? I don't know whether that's the right word or not, but we're looking back at the foci. So before we go into each of those, I'm just going to go back to that point that I made earlier about the FCA being criticised. Before Nicol Rathy's appointment, the FCA was being criticised by quite a few different people. There were forums that were criticising them, the government was criticising them, consumers were criticising them, consumer groups were criticising them, and they were being pushed left, right and centre. They had a failing authorisations team. There was a lack of dynamism and adaptability to changes in the market. There were suggestions that they were slow to respond. They were certainly slow to penalise. They failed to protect customers, particularly from firms trading on the fringes or outside the perimeter. And I think that's an important one because we'll come back to that point. So what happens? Nicol is appointed, and then what happens? So in 2022, he received a significant increase in budget, which is funded by regulated firms, so there's an increase in price. But what he also did was he hired 20% more staff, and those staff were in the authorisations team, they were in the enforcement team, and significantly, they were in the digital space. And we will again talk about that quite a lot. And the reason for that is that if you look at the firms that are regulated by the FCA, there's about 50,000 of them, and I don't think that includes appointed representatives. It's very difficult for a regulator like the FCA to regulate 50,000 firms. So historically, if you look back, you'll see that all of the enforcement proceedings, or almost all the enforcement proceedings, were against large firms, because large firms had supervisors and they had more regular interaction with the FCA. And what we're now seeing is that the FCA is trying to find a way to change that. They want to know which firms are performing and which firms aren't performing. And those underperforming firms, they're going to use digital analytic tools to identify them. And we will see as we go forward how they're going to do that, because a lot of the work they're doing now is about collating information. And for this year, there's another 8.5% increase in the FCA's budget. So we've got more money to deal with these issues again. Okay, could we have the next slide? We're now going to do some dive into these focus areas. So the first one is focus 1, reducing and preventing serious harm. And the first 3, dealing with problem firms, new prioritise action against the riskiest firms and those causing harm. New enhanced data-led detection and increased number of firms the FCA takes action against. Well, the third one's obvious. They've now got a bolstered enforcement team. They're going to be able to do that. But as I said, they have this issue with how they identify firms that are causing harm. And that is all about this enhanced data-led detection. If you think about this, and as we go through these focuses, you're going to see that they're asking for more information through the RMRs. They're asking for more financial information about firms. They're asking for more information from appointed representatives and their principals. They're asking for more information through the prod process. There's going to be more information they're asking through the consumer duty process. There's going to be more complaints information that they're wanting. And there's also going to be more information coming through the op-res. So that's a huge amount of additional information that they are collating. And they're going to use that. They're going to use digital analytic tools to identify those firms that are outliers. So, what we can see here is that firms that historically have sailed under the radar, if you want to call that, well, the radar is being reparameterized. The radar is going to go lower to the ground, and it's going to have a lot more capability to pinpoint problem firms. And that's what this is all about. And that's what all of that budget is going to be used for, and all of those new people. So those are new. They are new this year, and they are significant priorities that firms need to think about. I want to just tell you about an example of what used to happen. So there was a large firm. That large firm provided its reports to the regulators. They got them wrong. Within a week, they provided a new set of reports. Those were wrong. And then they provided a third set of reports, and those were wrong. And the regulators came to the conclusion that the firm didn't know what it was doing and had no proper controls over its reports and the activities in relation to its consumers. So it started a 166. About a year later, that firm basically closed down, and it was a firm that traded with about 300 million in income. That's what happens to larger firms when they fail to get their information right. I think with this new approach to digital, firms that aren't getting their information right to the regulators are going to find themselves on the fringes of what might be considered to be within the norm. But it's not just going to be those who fail to get their information right. It's going to be those firms that will be under the spotlight through simply being an outlier because their information is wrong. Is not wrong. Is different to everybody else. So the FCA will have details of your size because it has your financial information. It will be able to plug that into the tools, and if it finds that you have a higher level of complaints than other firms, it's going to be wondering why, right? particularly if you have a very small amount of consumer business. Those are just examples. You know, the way the analytics tools are going to operate that the FCA are building is going to be much more complex than that. All right. And then what happens when they do identify those firms? So they talked last year about testing the effectiveness of threshold conditions. They talked about taking action quickly and at scale, and they've achieved that. If you read the bulletins from the FCA website, you will see that there are regularly firms which are being closed down with their authorization is being withdrawn, and it's being withdrawn for failure to meet the threshold conditions. Now, why would they do that? Well, they want to protect customers, right? They want to protect consumers, and it's a lot quicker and a lot simpler for them to get to that binary situation where either you're meeting the threshold conditions or you're not. Because if you're not, they don't have to go through enforcement. They simply withdraw your authorization. So it gives the FCA a great deal more control and power to act quickly and thereby to protect consumers. So don't assume that if you're, you know, in the wrong place because, you know, they've picked up that there's something in your information which suggests that things aren't what they should be, that, you know, they will take you down the route of saying, okay, we haven't done a good job here. You know, we're going to look at fining you and asking for remediation. They may not go that route, okay? There's a much quicker and much more effective route for them now. If they're not happy that you are providing good outcomes for customers, then they have a very simple approach, which is to look at whether or not you've got the right resources. And that's not just about, you know, customer outcomes. They can look at, you know, is your IT suitable? Do you have enough resources on you know, any aspect of the business that is regulated? So do you have enough compliance people? Is your risk function operating properly? Do you have the right directors? And it's a lot simpler for them to come to the conclusion that you don't than it is to go through, you know, a long and difficult process of enforcement, which still, I'm afraid, is taking quite some time. So this is the best example you can get of their innovation, their assertiveness, and the way that they have adapted their business model to be more effective. Improving the redress framework. So at this point, you know, they are working their way through what rules there should be for FOS, whether they should bring SMEs into FOS, and how the redress calculations should operate. You will also notice, as I've mentioned before, there is talk about improved complaints reporting. Now, why do they want that? Because they want to be able to plug that into their analytics tools and see where you stand. Okay, so, you know, it's a very good example of what they're doing. And unfortunately, the redress framework, guess what? You know, it is like taxes. You know, it's there, it exists. It's not going to go away. The cost of it isn't going to go down, and nor is the cost of redress that people are expected to pay. All right, reducing harm from firm failure. We've already talked about how they can use the tool of threshold conditions to provide swifter protection for consumers. But what you'll also see now is that they are going to be asking for more baseline information about financial resilience. They're also going to be using data and dashboards and tools to identify those issues. It's all about data. One of those, so the baseline information that they want, that is bringing another 20,000 firms into the reporting process for the FCA. So, you know, when I talked about they've got 50,000 firms that they've got to supervise, and they can't supervise them because a lot of them are too small, well, they're finding ways, okay? And that's a very good example. This baseline information is going to be the first start of gaining more information from another 20,000 firms. Okay. Next slide, please. All right, we're still on focus one. and we're talking now about improving oversight of appointed representatives. So you can see that talking about testing firms, there are some new AR rules that are in place. They're going to test them the same way that they have tested people in terms of whether or not they're in the right place now with value assessments, product governance, and consumer duty. They're going to come out. They're going to do surveys. They're going to be issuing discussion papers, dear CEO letters, and where they see that there are problems because firms aren't where they should be, then you know what's going to happen. They're going to take action. And they will do that. They're doing that already on value assessments, and they're doing that already in relation to consumer duty. If your plan isn't where it should have been, we know that that's what they're working on. So there's going to be a great deal more engagement with firms, primarily, I should think, networks, because networks are one of those areas that they're looking at. So, and this leads us into the question about strengthening scrutiny. Principal firms, they've increased the oversight requirements. There is more oversight of firms' oversight abilities. And then there is that issue around legislative changes. So we know they've already, the FCA have already declared it, and historically it has been known that the AR regime is now being used in a way that was never intended to be used, and they are looking at how and what they do to change that. The focus is on networks, and the focus is on international ARs, so principals that have given AR status to firms that are overseas. These are simply not the way that the AR regime was ever intended to operate. And I don't think we know at this point in time what the outcome is going to be, but we know that they are looking very closely at that. I would think that that work will be complete this year, and we should know more next year about what the legislative changes are going to actually do. You will see there continued third bullet point down, more use of data. I'll keep making it. You also see it again on the next one, reducing and preventing financial crime, better use of data. It's all about data. Now on reducing and preventing financial crime, what we are seeing is daily warnings. We are seeing daily enforcement action. So the ante has been upped on reducing financial crime. We know there's going to be further work undertaken in relation to the assessment of systems and controls. All I would do at this point in time is to remind firms that there is an expectation that firms will carry out an annual financial crime risk assessment and ensure that they have identified the risks within their firm of financial crime and have in place the right policies and controls to match those risks. I think any firm that isn't doing that, and I know there are quite a lot, we regularly see annual compliance plans which don't make a mention of financial crime risk assessment. If you're not doing a financial crime risk assessment annually, you should get on with that and make sure that you are identifying what risks arise from your business model. Next, please. Okay, we're moving on to focus 2. This is setting and testing higher standards, and it won't surprise you that consumer duty is at the top of the list. I'm fairly certain that most, if not all of you, have seen the Dear CEO letter that came out this month. If you haven't, then I strongly recommend that you get a copy of it. It outlines what the timetable is, and it confirms what their expectations are. And it's a fairly simple expectation. They want consumer duty to be absolutely embedded at all levels of a firm. And we have worked on quite a few consumer duty programs for clients. We've also been asked to do assurance on consumer duty programs. And what we have seen a reasonable amount of is a failure to deal with this at a governance level. So there's a lot of focus on the product governance side because the FCA did say, was it this year, end of last year somewhere, that if you're meeting product governance requirements, you're getting a long way towards being in the right space on consumer duty. They emphasized, and I would emphasize again, that if you only focus on product governance, then you are not getting to where they want you to be, but you are getting most of the way there. What they want is embedded at governance level as well. That means the board of directors, the terms of reference for your board should include responsibility for consumer duty. It means that your internal audit function, pardon me, or if you outsource it to a third party, should have consumer duty and, pardon me, hang on. Your internal audit function should have within its annual plan an assessment of your consumer duty framework. Your risk function should have within its risk assessment work assessment of the operation of the controls relating to consumer duty. It's much more than just making sure that your products are signed off in a POG. The second bullet point, investment in new interventions team. Yes, they have not an entirely new interventions team, but there is at least 2 new heads of enforcement. So they have not 1 head of enforcement, but they now have 2. And they have been bolstering that team. And I do think that we are going to see more enforcement. We already know, for example, that on value assessments, they identified firms that weren't in the right place on value assessments. We already know on product governance, they identified firms that weren't in the right place on product governance. We also know that they are taking action against firms in relation to COVID-19 claims. So there's an awful lot of work going on. I don't know how long it's going to take them to get through that. But as I said, you know, that's the way that historically they have dealt with firms. And it will be the way that they will deal with those particular issues where firms are not meeting their requirements. I think that I want to move on next to the question around data monitoring. As you can see, there's still a focus on that. We know that the outcome of the Dear CEO letter, of the assessments, what they're doing here is that they're not allowing firms anywhere to hide. No firm is going to be able to say, well, we're almost done, we'll get there in time. That's just not the way they're doing it anymore. They're taking action earlier. And there is a need, therefore, for firms to make sure that their data monitoring is in the right place. And I will very briefly say that we will soon be launching a product, an IT solution that will help firms with that. But I think that firms need to know that, you know, if you're not in the right space now on your consumer duty MI, you need to get there. You need to get there very quickly because the FCA is going to be asking for the data. And again, if you're an outlier, it's not going to be a good place to be. Enabling consumers to help themselves. I call it small. I'm not actually a big user of social media, but it is a very important example of how the FCA is being adaptive. It's recognized that there are finfluencers on social media and that they are issuing non-compliant financial promotions. The FCA is taking action in relation to those. The reach of finfluencers is quite wide. It's an example of how they're trying to identify where consumers may be being misinformed about products. And they are now in a place where they can use digital tools to identify where that's happening and take appropriate action. We will see more of that as more and more firms use social media to distribute products or to promote financial products. Next slide, please. Okay. So ESG. ESG has historically and does even now remain primarily an issue for large firms. It talks about changes to the listing rules not something that impacts that many insurers here. There are certainly insurers that are listed here. There is going to be feedback on the DP23 of 1 statement on ESG, but mainly this is about large firms. However, having said that, the impact is starting to be felt by smaller firms, primarily because when they're looking for investment, their investors, their PE investors, their their equity investors are all now subject to the ESG requirements, and they therefore have to be able to provide reporting on ESG, which means that they are requiring the firms they are investing in to ensure that they have ESG frameworks. So we are seeing more input, more influence being imposed on the SME space. So your smaller to your medium size brokers and MGAs. There is a timeline for this, which is 12 to 24 months. That is going to mean that it's slowly going to roll down from the larger firms to the medium firms to the smaller firms. And I would also remind everybody that the S in ESG stands for social, and social includes very much culture. So that's why you see there is continuation in the approach to diversity and inclusion. It is coming to the medium to larger, from the larger to the medium to the smaller firms, and there will be more and more input, and there certainly is already around the culture side. We can expect an interesting announcement, I think, fairly soon in this space in terms of an intervention relating to culture. But I can't talk about that too much. Anyway, so that's happening. We will continue to see that impacting brokers and MGAs. So minimizing the impact of operational disruptions. We've all heard about OpRes. We've all now, I should think, know of the timelines and the discussion paper 23 of 2. This work is going to end up being exactly where, also I should say, the work by the FCA is going to have the same approach that they have taken to everything else. There will be mid-assessments while firms are trying to get themselves ready. Firms will receive surveys on where they are. There may be a review of whether or not they have plans in place. There will be, at some point, Dear CEO letters. There will be a proactive and assertive approach from the FCA. There is nothing to suggest that they will treat this any different to any of the other areas of focus for them. And as you can see, there's going to be a requirement for increased reporting of operational incidents. And I'll give you an example of how this could work. So if you're using an underwriting system and you have an outage, and that outage, it's a, I don't know, a cloud-based system, and the outage is due to the system itself. If there are 25 firms that report that outage and report an operational incident, and 100 firms that don't, well, guess what? You know, it'll be pretty obvious to the FCA which firms are doing the right thing and reporting accurately and which firms aren't. And they will have the ability to identify that very quickly. And that is a really easy example of the way that the FCA will be able to get down into the weeds with the medium-sized and smaller regulated firms, because they are going to have the tools that will allow them to do that. And in some cases, they already have those tools. Obviously, OpRes is just kicking off in some ways, so it will be a while before they have that capability, but it is coming. And I think that firms need to understand the importance of making sure that they are reporting matters and they are reporting accurately. Okay, next page, please. we move on to promoting competition and positive change. We've got here preparing financial services for the future. There are a variety of things that they're doing around that. Most importantly, there's the bill in Parliament for the Financial Services and Markets Bill, which is still going through the process. These all relate to the Edinburgh reforms, where the FCA and the PRA are working together. This is a post-Brexit approach. They want to improve financial services here. They want it to be competitive, and they want to be able to carry it forward to make the UK continue to be competitive. But and I guess, I mean, one of the areas for MGAs, which is probably the most important, is a review of SMCR, and we know that that's out there. We know that they're looking at SMCR and whether it's been effective, whether there should be changes. You know, there's been a lot of talk about the fact that really there's not been a lot that has come out of it. There's a huge amount of work for firms, and yet it doesn't have any impact. Well, while they're talking about reviewing it, guess what? You know, last week, I think it might have been last week, they finally had the first really big fine against an individual under SMCR. It was the CIO, of TSB Bank, and he was fined personally £80,000. That's £80,000 that is not insurable because it is a fine. So it's against public policy. He was unable to have insurance for that fine. And it was in relation to the problems that TSB Bank had, which actually ended up resulting in PRA and FCA putting together the proposals for operational resilience. Many people were unable to access their bank accounts while TSB moved from one software provider or one system to another. That was ultimately what led to OpRes. There were obviously other things that had got there too, primarily around cyber crime. But that is, and so while they're talking about making changes because, you know, it is administrative, it's heavy duty, they're also still out there fining people. So I don't hold out a huge amount of hope for significant changes to SMCR because they finally got their hooks into that and they're finally evidencing that as far as they're concerned, it works. But there are other reforms. Those reforms are there to try and make the market more competitive and more efficient. And we'll have to see where that gets to with the bill in Parliament. I think this is the final item that I wanted to talk about, shaping digital markets to achieve good outcome. For those who didn't note, big tech has entered the UK insurance market. This month, Amazon has become a part of one of the home aggregator networks. So Amazon are out there. Amazon are now distributing home insurance. And this whole area for the FCA is about, you know, what does the impact of firms like, you know, big tech firms like Amazon coming into the insurance market, what impact is that going to have on the UK market generally? But it's not just about that. It's not just about big tech firms coming in. It's also about other technology. You know, they're starting to think about ChatGPT, for example. What sort of impact will ChatGPT have on the way that firms interact with their customers? And equally, what impact will ChatGPT have on the way that customers interact with firms? Is it going to be an empowerment for customers? Is it going to be an empowerment for firms? Or is it going to be some form of utter chaos? Think about what might happen if an individual, if a consumer types in what should be the right level of remuneration for an insurance broker, or how is an insurance broker paid? what sort of questions might you get from somebody who uses ChatGPT to help with that? What if they start trying to put together their own insurance policies and asking you to, asking insurers to underwrite those? It's an area that is, it's an unknown at this stage what that might be, but there's an awful lot of people who are trying to work out what needs to be done at this point in time to ensure that the market is not disrupted in a way that could cause harm to consumers. And that is what that is all about. Next slide, please. Right, so this is, I'm actually at the end of what I wanted to cover. This is just for information. This slide sets out some timetables for you on areas that I've already covered. Feedback statements, discussion papers and the like. Some have, some don't have timetables. Some are unknowns. They're not unknown unknowns though. They are just unknowns. We can't tell you, for example, what time the timeline for testing the new rules on appointed representatives. We can tell you it's going to happen with a reasonable degree of certainty. We just don't know when it's going to happen. And what we would say is that if you're concerned about whether you're in the right place on appointed reps, then I'd work now to get yourself into the right place because that is going to come. So that's what that page is for. It's just a piece of reference so that you can, in one place have a summary of the key issues to think about. Can we go to the next slide, please? The next 2.5 slides or 3 slides are an assessment or a review of last year's plan against this year's plan. As you can see, there's an awful lot of ongoing. But again, there are some new things, and I think that that should help you to see where you are and what are the newer parts that you need to pick up and work on. So again, it's reference material only. Final, next slide, please. Not final slide. Next slide, please. Next slide, please. Okay, so final question is what I meant, not final slide. Do you feel more or less positive about the regulator regime? I'm hoping that I haven't been too negative. All I'm trying to say is that there's an awful lot of work and that I think that the FCA are getting better at what they should be doing. So do you feel positive or negative? Are you about the same? We'll give you maybe 30 seconds more, please, to have a view on that. Oh, wow. Okay. More positive, 33%. Well, that's pretty good. About the same, 55. I'm a bit worried about that. It sounds like everybody may suffer a bit of depression occasionally or something. Anyway, less positive, 12%. I'm surprised by that. I was expecting more people to be in the more positive area, because I don't think that there's huge changes here. I think there is more work, but I don't think that it's more along the same themes. It's more along, the same requirements. And if we flick on to the next slide, there it is, more of the same. A change in regulatory style, it's the style. It's just what we're going to have to get used to. If you're not used to it now, then you will be, I suspect, by the end of the year. There's going to be more testing, appointed reps, op-res, compliance with TCs. And the consumer duty is just, that's going to be there. It's as I was saying in relation to FOS, it's a bit like a tax. Once it exists, it's not going to go away and it's not going to get lighter. And then I should have had another bullet point at the end of this, which is that, the FCA is trying to be helpful when it issues discussion papers, when it issues Dear CEO letters. It is trying to give some help, but equally in the back of its mind, it knows that when it does issue these things, then it reduces the opportunity for anybody to say, well, I didn't understand, that's what was required. So that's That's it, I think. There are some useful links there for you if you need them. These slides will be circulated shortly after this. And we now need to go back to the learning objectives. And I have to repeat these because I am hoping that this is correct, that you have had a summary of the changes to approach, that I've documented the specific areas that the FCA will be concentrating on. You get an understanding of the likely impact of the changes in approach and the changes to the strategic change on the way the FCA is working, particularly around consumer duty, product governance and fair value, and that I've explained the intention of the new secondary international competitive and growth objective, which is all about Brexit. Okay, can I take questions? Do we have any questions? I see somebody's got something in chat.
We do. Yeah, I'll just read that one out from Mark Tyler. Good question. Hi, Kenneth. Given the costs involved in investing in improving systems to meet data catchment standards, whilst ignorance/cost cannot be used to justify non-compliance, have the FCA done any work in forecasting or modelling the number of SMEs who could go out of business due to the costs?
The answer to that is, I suspect no. I think that it's unlikely that they have done that modelling. Historically, BIBA and BIBA's been the main market association that has done that sort of modelling. And I think that if you have some concern around that, then I would talk to the guys in BIBA, because they have been quite vocal about, the increase in regulation. But the FCA has statutory objectives. Those objectives are to protect consumers. And they will justify their position on the basis that if a firm can't afford to manage its business appropriately and protect customers appropriately, then that firm shouldn't be around. I'm not saying I agree with that, but I do think that there will be firms that give up, in the same way that, when there were significant changes in the life sector, quite a few people just said, I can't do this anymore, and they retired, or they moved to a different field. But it could drive more consolidation. I mean, there's huge amounts of consolidation in the market in recent years, driven by the cost of capital. The cost of capital has been very low, so people have, so larger firms have had access to cheap cash, cheap capital, and they've used that for consolidation. I don't see that 4 or 5% in terms of cost of capital. Well, it's higher than that, but I don't see that will change significantly, and so there may be more consolidation in terms of whether firms will not be able to meet these standards that the FCA requires. I think that's I think that they would look at that as an unintended consequence. But if you want somebody to fight your corner on that, then the place to go is to go and talk to the guys at BIBA and the MGA, I should think, because I think that the MGA has done some work in this space. Sorry, guys, I was a bit slow on that one.
Absolutely. Yeah, any questions, don't hesitate to send them through to tim.richards@mgaa.co.uk, and you can see Ken's details there as well if you have any questions on the presentation. So I'll leave it there. There are no further questions. So thanks so much, Ken, for your presentation today, which I'm sure everyone will agree has been extremely useful. Thanks to everyone for joining us. Please don't forget to provide your feedback, and do look out for forthcoming MGAA events. The link to the slides and the video will follow shortly. And it just remains for me to say that, as always, I do hope you have a pleasant and productive afternoon. Thanks again for joining us, and see you soon.